Right, so the central thesis is that severe economic downturns are caused by elevated debt, in particular in the household sector. And when you have some massive shock to the economy, let's say house prices fall by a dramatic amount, it is the disproportionate effect of debt on the debtor who pulls back very sharply in their spending, which then sends the entire economy into a tailspin. And that's kind of the main thesis, is that we need to think about why debt does this and what some potential solutions are to this big problem. Right, so the distribution of debt matters a tremendous amount because people in the lower half of the income distribution tend to have much higher marginal propensities to spend. For a given shock to their wealth, they pull back more on spending. And if someone has a lot of debt and house prices crash, they see their entire equity position wiped out, and that therefore leads to a big drop in household spending in the aggregate. And once that happens, it starts in a cycle of higher unemployment, more foreclosures, and that can be particularly problematic for the macroeconomy.
In the short run, the key message is that you want to restructure the bad debts. So you want to restructure the mortgages, allow underwater homeowners to write down the value of the principal that they owe, rather than forcing them into foreclosure, because you have in the US, for example, 4 to 5 million people who are forced into foreclosure. There is no way the system as a whole can absorb those many houses on the market without having a further negative impact on house prices and sort of kicking back into that negative cycle that we talk about. So you want to change the incentives of the system in a way that allows for this kind of restructuring in the aftermath of a crisis or a negative shock to house prices, like what we saw in the US and Ireland and Spain and other countries. The shared responsibility mortgages, the idea is to add a contingency to the existing mortgages, where that contingency will kick in place whenever there is a macro downturn. And by macro downturn, we mean a downturn in your regional or city house prices. So whenever that happens, instead of the lender demanding the same amount of principal back from the borrower, the mortgage will automatically be written down proportionately for the time that the house prices remain subdued. And as a result of that, there will be no borrower who will feel underwater if house prices were to go down, and so they can continue their spending behavior the same way as before, because their mortgage has automatically been adjusted downwards. If house prices go back to their original level, then we can increase the principal back to the level it was before. But essentially, we are allowing for the mechanism to have more risk sharing between the lender and the borrower. Now, if you introduce this system, you want to give an incentive to the lender as well, because now they are giving up on the downside. They are taking part of the loss on the downside. So we propose giving them a small piece of the upside. So at the point someone sells the house, a small proportion, a small fraction, which turns out to be just 5 percentage points of the total capital gains, net capital gains, can be given to the creditor, to the lender. And that is sufficient to compensate them for the insurance that they are providing in the event of a macro downturn.
Right, to me the biggest risk in the United Kingdom is probably not a collapse in house prices, but more the fact that borrowers have adjustable rate mortgages, and if interest rates go up, then there's going to be a pinch on those exact borrowers, those borrowers that are mostly indebted. So the fact that the household debt to income ratios have not fallen in a dramatic way as they have in the United States does lead some residual vulnerability for the UK household sector that I think is worth thinking about. Probably New York City. New York City had a very similar thing where house prices didn't crash as much.
Yeah, exactly.
So rather than a state, we'll say the United Kingdom and London in particular would be very much like New York City, I think, in terms of being more of an open economy, very high income levels which sustain higher real house price growth, and New York did not have nearly as big a correction as most other markets in the United States.